Hello, folks. It's Dave Russell here, VP of Market Intelligence at TradeStation. Can you guys just confirm that you hear me okay? I shared the link. Let me read the disclosures. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. Strategy trading and active trading is not suitable for everyone. Futures trading, options trading, and active trading is not suitable for everyone. Past historical performance does not guarantee future results, may not be indicative of future performance. All educational content and custom easy language studies provided are examples for educational purposes only. Neither TradeStation Group or any of its affiliates suggest, recommend trading indicators, scan strategies, or any other investment or trading advice of any kind. You alone assume any trading risks associated with the analysis and trading examples provided. All right. Well, great to be back with everyone. This is Market Insights, and the article we published yesterday, kind of looking out, preparing for this week. And the big event is the Jackson Hole speech. Friday really has two items, and it's just kind of creating this this big dread hanging over the market right now. The main thing is Jerome Powell, but we should also remember that the CPE, which is the inflation number that the Fed likes, the consumption, I can't remember what it's called, PCE, I'm sorry. So on Friday, we get at 8:30 Eastern, we're going to get personal spending and personal incomes. And there was a day when no one even cared about PCE, but inside of that report is the PCE. And so that is another important thing that's on Friday. So both of those things are out there on Friday. Now, it's pretty interesting when we look at, this is the CME's FedWatch tool. And when we look at the September meeting, it's pretty evenly divided between, 75 and 50 basis points. What's interesting to me, and we mentioned this in the article, was that Mr. Bullard said 75. From my perspective, I've noticed at the Fed at different times, there's different people who are like kind of the influential people. And right now it looks like Bullard is the guy. There was a time when it used to be Clarida, he's gone now, but Clarida used to be the guy. And now it seems to be Bullard. And most of the other people are just kind of following and going along. So it's interesting to me that we see that, and that's just where it is now. Now, from my perspective, when you look at the market overall, this creates the potential for continuation to the potentially to the upside, because I've just never seen this much fear in my life. I mean, I try to watch as many of these interviews on CNBC and Bloomberg as I can, and everyone universally, even a perma bull like Tony Dwyer is just bearish. So overall, to me, look at this environment right now, and we should remember that the last PCE report, we look at some of the other things here, if we go to events, economy, we have seen some signs of inflation peaking in a lot of different things. We wrote this article a while back. And then look at the news today. What do you have? Macy's comes out and says they're going to be cutting prices. So we see a slowdown in housing, which is also going to be consistent with lower prices. I watch different real estate things, and I get these reports from Zillow, price drop. So overall right now, this is, to me, kind of what, when people talk about a wall of worry, it's more like a wall of dread and hatred and just absolute depression, because most sentiment right now is so bleak. But from my perspective, I think that's something we need to kind of bear in mind as we look at the market overall here. One of the things I think most interesting is I look at a lot of these bears like Katie Stockton, and she comes out and she says, well, the recent rally was bigger than I expected. And it's like, all right, well, maybe that says something. So let's look here at our workspace. Most of you guys probably know. If you do not know my workspaces that I've shared with you guys, then tell me in the chat, and I'll help you with them. But these are the ones I always work with. I'm going to be updating them soon. We're going to be maybe just changing a few things, and I want to just I'm just waiting for a little bit of clarity before we we changed them. I still am pretty happy with these. If we look at breadth, and now we wrote an article about, where did we do this? I'm trying to remember now. Stocks above the 50, it was stocks hitting new highs and above the 50-day moving average. I'm trying to remember where I had done it. All right, so this is the S&P. This is SPY, and it has these under it. This is companies above the 20 and 50-day moving averages. In my world, blue is 20 and red is 50. All right, so it's a 20-day. So this number here, the companies above the 50-day moving average, which went up to like over 400 at some point recently. That was the highest number in over a year. Another thing I've written about is, and I've written about this over here with the VIX, and I think it's very important. And not a lot of people, I mean, honestly, I've not seen anyone else do this kind of analysis, but this thing I did on August 3rd about the VIX dropping has proved pretty prescient, which was that this steady decline in the VIX, which you can see here with this custom indicator I created, and we talked about this last time, but I think we have to remember all these things are in place. You have an impulse in the market, like a thrust, consolidation, and then the potential for continuation or not. From my perspective here, this was a significant thrust. And we saw it in many things, like the stocks above the 50-day moving average, the decline in the VIX, the fact that we made a higher high. We broke that June level. Very big deal. So to me, this coming back and looking to hold this level is really what we're doing right now. And I think we just have to be extremely careful to be overly bearish. To me, that is the biggest risk right now, because everyone is so negative. And the thing is that this is exactly where we need to see holding this line across here. There's different places you can draw it. This is one of the things that maybe everyone struggles with this, but I look at this and it's like, where exactly do you draw the low? To me, this March line was hugely important. And you can see it was resistance in June. And now here it is in different ways. It was a consolidation and breakout. This level, no matter what happened. I mean, Jerome Powell comes out and says, we're going to cut interest rates. It seems like it doesn't matter from a technical perspective. A level like this cannot go untested. It doesn't matter what causes it. It's one of these things that simply has to be done. And it's been done. So I think that's something now to think about. So that's kind of where I'm focusing right now. When we look at the breadth here, everything in my view confirmed that this was a cessation of the bear market. This advanced decline line, this was significant. This was significant. This was significant. And this VIX thing was significant. If we actually look, I did this last time, but we ended up with the VIX dropping, I think, for 8 straight weeks, which hasn't happened, which almost never happened in history. And like the thing is that there's a point there where that fear just doesn't hold anymore. And I'll go back to this, and I remember in 2000, because I lost money on it, 2009 or something, after the financial crisis, there was a company called CIT. It used to be a relatively important financial, and they went bankrupt. And everyone thought, oh no, the financial crisis is coming back. And it didn't. And I think right now we just have to just realize that, these things happen, and then they come back, and we have this, this post-traumatic stress disorder or something, and we're just terrified that horrible thing that happened to us here is going to happen again. And the problem is that if it doesn't, then we have a situation where, there's a lot of people on the sidelines. And that seems to me more where we are right now. And I say that because look at like I said about Macy's, the inflationary numbers. And then if you look at, what's happening, with Europe and the dollar, this is deflationary. China and Europe, together, they're probably GDP wise much bigger than the United States. They're both facing like catastrophe economically. And while that's not good overall, it does two things. First of all, it makes the United States the only place in the world anyone wants to put their money. So that's one issue. And so if you're a rich Chinese person or a rich European right now, and you say, where do you want to put money? Your answer is the United States. So that's one thing right there. It makes the United States attractive as a place to put money. But the other thing is that it's deflationary. And it does create the risk no matter what Jerome Powell says. And from what I can see, what Bullard says, 75 is probably in play, but it creates, I think a significant risk that this Fed is going to have to be careful of what they do, because the euro could go into something very cataclysmic. It could go into like a real spiral, and it could it could pull a Deutschmark or, a Reichsmark, whatever it was back in, 1919 or whatever. Not to that extent, perhaps, but the thing is, when a currency starts to blow up, like we look at the euro here, we're looking at breaking parity, and if the bottom really falls out of this thing, obviously all that is, a negative to a certain extent, but we also have to realize that the flight to the dollar and everything else that can happen in that environment. So I think right now, I just look at all these things as a lot of horrible, terrible things that are happening. But at the same time, we have a situation in the US economy where, initial jobless claims have been better than expected the last 2 weeks. What's interesting is the last Philadelphia Fed was better than expected. Leading economic indicators in July were better than expected. And retail sales last month, that number that came out was, it was totally skewed because gasoline prices came down, and it actually resulted in a low number when you take away gasoline prices. But then there was a lot of strength in other areas. I continue to go back to the fact that the American economy is readjusting to an employment growth economy. We don't have debt problems. We have rising wages. We have excess demand. And most people are not broke right now. People have money. They might not want to be spending it. They might think they're spending too much on whatever. But the fact is that there is what we call in economics aggregate demand exists. And that is ultimately the only thing that really matters for an economy. And I would say, in addition to aggregate demand existing in the economy, it exists among investors. There continues to be significant cash on the sidelines. And when you look at it, a non-recessionary environment, which people can say it's recession all they want, but is it really a recession? So I remain in the camp of us essentially being in a wall of worry environment. Let's go back to the S&P here. There's a weekly chart. I'm going to go to the daily, and let's just kind of take a look at this. And like I said, this is where we are on the overall cash index. This a pullback like this after a rally of this strength, the question is simply, does the bottom fall out and it simply goes straight back down again? When you still have the 8-day above the 21-day, when you still have a lot of the momentum, pointing more to the upside. So that is essentially, what I essentially see here when I take a look at some of these big pictures. As we turn to the different things on our masterclass workspace, the move in energy has been something that I'm pretty sure we talked about it last masterclass. I know I talked about it in the webinar. I did the webinar last week, and I was talking about how the natural gas situation, in particular, I pointed out this article that I had done on natural gas, and I was kind of flagging it as saying some of these are names that maybe we want to be looking at. It was this article here, and it's interesting that the divergence between natural gas and crude oil right now is historic. In fact, I want to show this to you. I haven't looked at this again in a couple of weeks, but these are some of the things I think we want to look at. Let's look at NG, which is natural gas, at sign NG. And then if we go to data, add symbol, we're going to add CL as a second symbol. And then we're going to add studies, spread ratio. Let's look at this on a monthly basis. This is a data anomaly, but if we look at this right now, look at it on a weekly, see maybe it's clearer. What we can really see is if we exclude this one anomaly that happened when crude oil went negative in that freakish way, this, we're basically, this was caused here. If you look, this is natural gas, this is crude oil. You guys might remember right after COVID, in like April of 2020, crude oil futures went negative, which who knows how exactly that happens. But then the thing is that creates a false number here. But if you look past that and you look at this current level around, 0.10 as a ratio between them, once you look past the anomalous environment of coronavirus, and we can just do here is we can go to drawing horizontal line and we can put it right at this level. For most of the history of this data, it should be, quote unquote, it should be in a different place. So the point here is that natural gas is extremely expensive relative to oil. And that's something we were talking about at the time. We had actually talked about this ratio at the time. You can see most of the history, it's under there. And that's kind of where it, quote unquote, should be. So anyway, the point though is focusing on the natural gas companies is, something here that we had been kind of pointing to and focusing on. From my perspective though, now it's like we have to be careful because first of all, this story is really out there. And I think we're at the point where we also have like the risk of these other risks that are happening. And the main risk is that Europe's next step is to simply turn off their factories, turn off their gas, turn off their economy. And when that happens, what happens to oil? What happens to materials? Again, these are kind of problems that I don't want to say they solve themselves because it's really difficult if you live in Europe. But the problem is that from an economic perspective, they kind of solve themselves. The natural gas crisis leads to a recession in Europe. That leads to deflation. And then that's something there. So the other thing is at the end of the day, the market looks out and it has trouble truly believing that we remain in a situation of Ukraine just being this dominant force. The market at a certain point says in some way this Russia-Ukraine thing is going to go away. The market doesn't want to believe that Russia and Ukraine are simply cut out of the European, Eurasian economy. And so that's a problem with a geopolitical event like this, is that there is a massive potential for a relief rally. And the market simply says, I'm just not going to believe that this remains forever. And that's the reason why crude oil has not rallied that much. So I remain in a situation here where we have to be careful of crude oil has not rallied that much when we consider the environment. If we look at where the the inventories are, oil inventories, it was the SRE, the Strategic Petroleum Reserve, hit a 25-year low. Crude oil inventories are to their lowest level in 15 years or something, and crude oil has not rallied significantly. I'm always wary when price does not correspond to the news. You can make all the arguments in the world about why crude oil should go higher, but the risk here is that for some reason something falls out of this. And I'm not in any way saying that people want to be short energy. I was in many ways kind of leaning toward the direction of being long the energy stocks here. But what I am saying is that right now we're in a situation for the overall equity market where the real risk could be that all this horrible stuff goes away and the S&P is holding a key support level, and suddenly people have to buy. And that is more the kind of base case that I'm working with here, is that the fear subsides and people are suddenly caught, oh my God, the world didn't end. And that's where it seems to be right now. It's funny, I was just thinking of the movie Cool Hand Luke, and there's that scene when he says, he's bluffing in poker and he says, sometimes nothing can be a pretty cool hand. And I think right now I was kind of thinking, what happens? We've been through so much after not just COVID, but before that, we had Trump and these trade wars with China. Then we had COVID. Then we had Russia. So what happens if we basically say, no COVID, right? No war, no inflation, no crisis, and just sometimes nothing can be a pretty cool hand. What happens if we have just a nothing rally because of simply the fact that nothing is happening anymore and that everything bad is priced in? And I think that that is the sort of thing that we have to be on guard of. So anyway, I think I'm making my case here kind of, and as I look at this now and we look at where we stand overall, let's kind of dig down into some of these, some of these ETFs and see, because some of the things that was really interesting to me recently was to strengthen some of these things like the small caps and the transports. Again, this is not consistent with a market that really wants to go straight down. We also see here that the growth has been kind of outperforming in the last month. Nothing here really points in a truly negative sort of direction. As I kind of look at this, I see I'm kind of trying to look for any patterns that pop up as of kind of today. And let's look over the S&P here. These were my solar stocks last time, which I think I showed you guys. And again, this is another area that we probably want to be looking at. I'm going to bring in the S&P 500 and see if it shows us anything interesting. Bring it in on all three of these. I see any questions. What do I think about the bond market in general and the 10-year in particular? I've been watching these, and I'm going to bring over my trading view chart because sometimes that's just a little bit easier for me. But I do want to mention that today we did do an idea on trading view about Ethereum. And this is another one that I kind of wanted to highlight. And it's another like a nothing burger rally. When you look at this, negativity is very high in this. We have the merge coming in September when they upgrade to Ethereum 2.0. I'm looking at Ethereum here. I'm like, all right, let's look at this. It's a 38% retracement of the rally. It's at the bottom, near the bottom of the Bollinger Bands, 50-day moving average in an oversold condition. So it's interesting to me here about Ethereum is, there's that thing of buy the rumor, sell the news. And I tend to believe overall, when I look at the way the market behaves, you have magnetic events, I kind of call them, and a bullish event that is a month from now will pull prices higher. And then when the event happens, you sell the news. Well, the problem with being bearish on Ethereum now is that the event hasn't happened yet. So it argues right now potentially in favor of people looking for that news event that's out there to drag the stock higher. And I think that's something that we need to kind of be on guard of here and be thinking about. So to me, Ethereum here is an interesting thing that we want to be kind of focused on and potentially thinking about. So I wanted to mention that. That was one that popped up. Now let's look at the 10-year, like you had mentioned. To me, and I wrote about it at the time on TradingView, the break of this trend line was really, kind of lights out to me for the increase in yields. And you have like this trend line. This was another trend line that came across, but I wrote right around here that this was that yields were done going up for a while, and that was 2 months ago, and they proceeded lower after that. I wrote that on TradingView. If we look over on TradingView, you can see. Go back and look at some of these. Here we go. Have treasury yields peaked? I wrote this on July 1st as it was breaking lower. So basically, this has behaved more or less as I expected, which is just a sideways drift and consolidation. And honestly, from my perspective, these lines here, right where we had this trend line breakdown, are important, right around this 3% level. So, from my view here, I'm actually thinking that it's a sort of a sideways move here in yields. And the big story here, and I wrote about it in this is that this was the high from October. So when you really look at this thing on a long term, like, if you really look at this on a long term or even like month or something, right? I mean, something like this, from my perspective, is going to take months to break. So I think right now the real issue with treasuries is you just have essentially the likelihood of sideways movement. I believe that the Fed has gotten more or less to, we know what they're going to be doing, and the bigger risk is that you know, is that they kind of slow down. I don't think they're going to slow down, and my perspective is in a year, 10-year yields will probably be higher. In 1 to 2 months, they'll probably be right where they are, and I think that's kind of where we are right now. Um, so when I look at this, it's behaved as I expected, and I'm just not sure that this is necessarily where we get the continuation at this time, especially with the summer coming. And for me, this could still have a period of consolidation here. This was there was that significant resistance level up there. So right now, that's kind of what I'm looking at. I have no real position or real thoughts right here in treasuries, but my thought in the near term would be that we're more likely, I think, to have chopping and consolidation, and more of a test to the downside in yield, and a sideways move. Um, that's where I stand right now. Europe needs natural gas. Yes, they do. And um, that's why we had highlighted that article about those energy stocks. And a lot of them really have, moved significantly. Let me just look at some of my other notes. This is just one of these markets where, like I've often highlighted this idea of focusing on trading the indexes. And honestly, yesterday I just bought a lot of SPY on the pullback, because it pretty much pulled back to the level I expected. And that's kind of where, I'm, that's, to be totally honest, that's like where my perspective is here. And I think that let's see if I look at some of my notes. All right, so let's look at a company like Ford Motor, because this was one that basically, here you have, to me, these are the kind of companies that we want to be thinking about now. A company like Ford, that, like, what's its fundamentals? Let's actually take a look here at like where Ford is, in terms of something like PE ratio. Wow, 3 times that can't be right. I don't know. But you're looking at, again, the valuation on some of these names. Something like a Ford Motor here is, to me, just this is, I think, where we're going to be seeing the strength in the market is going to be a company, like this. And the other one that struck me is that, a company like Macy's, same sort of thing, where they cut the guidance to stock rallies. We had talked about Foot Locker. I mean, a company like Foot Locker is so cheap, the valuation, and like every earnings report they have is good. It's an interesting stock, because there have been times when this company really would outperform, and they're in an interesting niche. I don't really understand exactly why they do well, but there have been times when this has been a very strong stock. So I think right now, it's going to be honest, the stocks that people don't want to own, don't want to talk about, the more boring, non-Cathy Wood names, the companies like the health insurance companies and some of these sort of names that have been breaking out to new highs, some of the industrial stocks, some of those sort of names seem to me right now where some of the some of the strength is in the market. But overall, to me, it's simply a question of the fact that money is coming back into the S&P, period. And once it comes in, people are going to find what they want to do with it. And that's really, I think, the way it works. We are not yet in a spot where we know what the next true leadership is. We are transitioning from a growth FANG market to something else, and we don't know what it is. I cannot overstate the importance of that. I think it's, being overly bullish on chips or anything else, I think is problematic. The thing that seems to me most likely will be the solar energy. Seems to me like like an end phase. We had kind of cited this down here. Some of these names have been pretty interesting. To me, this is interesting. These are candidates for leadership, but to me, so is a Ford Motor. So is like a Foot Locker. I mean, some of those kind of companies like the Macy's, some of those more obscure sort of traditional retailers. And like I said, it's the nothing trade. It's the no COVID trade, the no end of the world trade. And then it's suddenly like, well, maybe he'll just go back to shopping malls and a return to normalcy. And when you consider how much some of these companies have pulled back, that's why I think we need to be looking for some of these other areas, and looking at companies that had good earnings reports and stuff like that. Some others along that, for example, Home Depot. This is one that popped up here to me. I mean, to me, this chart is very sloppy. But again, this is going to be one I think that I'm kind of interested here in seeing if we get something around 300 on a name like this. Strong earnings. It's really been basing. That was one that was on my list. Walmart also. Again, the world didn't end. They didn't lower guidance again. A company where I think when you look at this remains in that correct spot. Luxury retail is problematic in an inflationary environment. A company like Walmart, we had also written a lot about things like Dollar Tree and some of these, discount retailers. These are the non-Cathie Wood stuff. And I think that's kind of where we are right now. But I'm sifting through some of the companies that had good earnings reports and looking to those. Now, the other area, and I would say, and like I said, to me, it's not really clear where that leadership is going to be. My approach is to focus on indexes on the downside, indexes in the beginning of a rebound, and then after we achieve stability, then we focus on stock picking and trying to, seek what people call alpha or individual leadership, sector leadership, stock picking, and stuff like that. And that is when these key ETFs will be most useful. For me, for the most part right now, none of that is particularly obvious. I'm not even sure, and to a certain extent, some of these ETFs might be problematic because these are the ETFs of yesterday. These are the ETFs of FANG and of, whatever, things like software. And a lot of these are the areas where when you look at it, their outlooks are simply not as great as they were. I look at a company like CRM. I've been looking at a company like this, and to me, it looks like it's such dead money. A company like Meta, and I think the problem is a lot of the categories that people have been using, these categories themselves are getting old, so like I said, we need to be looking for individual sort of areas that are starting to outperform. From what I've seen so far, solar is one of them. The other one are the lithium stocks. So I'm going to go back to these. This is one that I own, SQM. This is one that I've been in and out of. I kind of did a trading view idea on it. Right here is it broke out. The earnings were kind of mediocre, but the growth is exponential. ALB, lithium producer. LAC, lithium producer. And the other one is ENVX. They make batteries. So this is an area here where it seems like there's a lot of, just an area to be focused on, to be thinking about. And it's going from clean energy to dirty energy. I've also just noticed the ongoing strength in some of these coal mining stocks. These are just names that I think I'm not even sure right now exactly the outlook is for them, but some of these have had significant basing patterns. They have significant uptrends, and going into the kind of winter season and everything else with the European thing. I just saw some German utility is turning its coal plants back on. So some of the coal mining names, AMR, BTU, Arch, they've all had these kind of jumps, and all of them to me just remain highly kind of, the opportunity is not super clear in them right here. But again, some of these are things where if we want to be thinking about looking for alerts using some of the techniques we have here. So for example, we go to our MA tools, we have EMA test. So we're looking at, say we want to be looking for like the coal miners. So we can say, you know what? I love Arch on a pullback to the 8-day exponential. You go here and it will light up when it touches that 8-day exponential. In another, I've shared this, and I shared this in my last webinar. I have this other one, which is EMA. It can fire off an alert when it hits the exponential moving average. I'm going to share my email with you guys if you guys want. If you don't have that indicator, it's called EMA with alert. If you don't have that indicator, email me, I'll give it to you. So you can watch. So from my perspective, having the list of stocks that are, potentially interesting, and then looking for these opportunities, like a pullback to the 8-day or the 21-day, because something like this in this kind of overbought condition, it's very difficult to have any kind of clear edge. There were some others though that did pop up. I was just scanning. I was scanning for some pullbacks lately, and as I did that, I came up with the biotechs. Biotechs had a significant sort of bounce recently, and there's been M&A in the space. So one of them that I was looking at is VERU. This company's had a series of different things. I think they have some kind of monkeypox vaccine, but they had a really bullish earnings report. Now it's retraced a lot of that. This is one that popped up today. I'm trying to remember what the scanner was. I think it was a company that had recently made a 52-week high and then had pulled back, something like that. So we can actually, let me show you how to do that scan. Before we do that, let me just show you the other names that came up on my list. One of them was SNPS. Only 2 semiconductor stocks have made 52-week highs recently. This is one of the two, SNPS, Synopsys, excuse me, and the other one was onsemi. Both of these made 52-week highs recently, but SNPS was interesting just for this kind of rally and pull back down to the Keltner channel. And this one came up on my list because it also made a 52-week high and pulled back. Some of the other names that I've been watching, I've also been watching Vertex, the biotech stock. Some of these are kind of, they plowed to new highs and now they're pulling back. But some of these I think are interesting to watch. Some of these big pharmaceutical names, Vertex in particular, has been trying to kind of break out. They had a good earnings report, so this one was on my list. All right. Trying to see if there's anything else that really. All right, let's do scanner. I'm just looking over at I have a little radar screen. I'm watching to see if anything interesting is popping up on it. All right, let's go to scanner. I call this one recent highs, and let's see what we actually have on it. I have this indicator called day since 52-week high or low. I'm going to remove some of these things and we're going to just, well, I'll build it from scratch. You can see this, create a scan. Call it new high pullback. So you can do all this with the indicators I've given you. If you use the workspace, if you use the ELD I gave you, it includes the necessary indicators. So I'm going to go to all stocks. This is going to bring up. So I default to $1 billion market cap, 500,000 of share volume. I'm going to go to indicator. And then I'm going to go to days since 52-week high low. All right, and I'm going to set that to less than 20, less than 21. Made a new 52-week high in the last month. That's what that's going to do. And then I'm going to say, but I want it to be down in the last week. So price in the last, let's say go to price percentage change, 5-day less than 1, for example. And let's also, another way, something is this scan's going to take a long time, so we can expedite it by doing this. There's this other thing, which is, it might be under price. There's another criteria under price, which is percentage of 52-week high or low. This one, let's set it to greater than 50. That means these are stocks that are above the midpoint of their 52-week range. And by doing that, you can see that it quickly whittled it down to 350 symbols. That is a server filter, as it's called. And by running that, it exponentially accelerated my scan. So now let's look at them by market cap, see the biggest. And what do we have? We have Pepsi. That's kind of, whoa, that's an interesting chart. and just came up here. Pepsi jumping up. T-Mobile, which is interesting because, Verizon and AT&T have just been a good place to not make money. These guys have been horrible, and you have T-Mobile, which has been essentially hitting new 52-week highs. It's an interesting name. Another one, this is interesting, ADP. Look at this. This company runs payroll services. So these are some of the scans I'm interested in now. We can also sort by who's down the most in the last week. Whoa, there's Veru. There we go. That one came up on our list. Let's look at what else. Sega. I'm trying to remember what this company is. Is this a vaccine stock? Can't remember. By the way, if we do want to know that, we can always go over here and we can add industry. I'm just going to very quickly look on my other screen. Yeah, I think it's a monkeypox or something. Oh, here's another one that came up on my list. American Axle. I'll tell you another one that to me popped up. GPC. This is an auto parts company. But the thing we've been seeing is, like I mentioned with Ford Motor, General Motor, some of the auto related names remain extremely strong. And I think that's something here. GPC is an interesting company that had a breakout here. Auto related. Now, again, at this point, we probably have something, we're probably looking for something closer to, a deeper pullback in a name like this. But when a company's breaking out and the rest of the market is down, that is a sign of relative strength. And this is kind of what I'm talking about. This is a new market that's emerging before our eyes. And some of those names, like the reason I liked Vertex, or I don't want to say I liked it, but I'm interested in it, is it made a 52-week high right here. And this is the sort of thing where making a 52-week high, now it's back to the 50-day moving average. The question is, 3-4 days from now, starts digging down maybe close to 280. The people who pushed it up there, is there more, are there more bids down there? And I think that's kind of now some of the things we're going to be looking at for some of these companies that are breaking out in a market that is still, under its 200-day moving average. And that's why I like to do this thing of looking for new highs and stuff. That is interesting to me. I don't know if this generated any other potential things. A lot of these are too small, but there is Synopsys, there's Vertex, ALNY. This I don't know what the company did, but this was another biotech. But I think they had earnings. Here's an interesting one. This WWE. This has been going through all kinds of interesting personality disorders and strange executive news. But this is another one that's interesting, a potential wall of worry stock. Another one that I actually should mention is Nexstar. This is a TV operator. This company stands to benefit from the midterm elections. They operate a lot of traditional local TV stations. Just looking down my list here. AutoNation, that's interesting. Look at that. What is this stock trying to do? So this is like these are some of the things that, at this point in time are kind of my, my process that I'm going through and trying to look for some of these things, and I'm using, TradeStation to do this. So the market just continues to kind of sit here. It's just kind of holding at the same level. Not a lot of volatility anywhere, and trying to see if anything else has really popped up. To me, like I said, the breadth is really the big thing here. This was a pretty significant kind of move here, and to see stabilization here, like I said, this is still, I think, a significant thing. Either this is the Ukraine low, the war, when the war started, and then this was this rally before the Fed held, and then it rallied on a Fed meeting. And so this area here to me remains a pretty important place to be kind of looking. Like I said, this is a period of the summer when there's often not a lot of volume overall. Although at this time I'm I just think we still have to remember that there is still, I think, the underlying condition right now of a lot of cash on the sidelines. That remains to me the single most important thing to focus on. You can mess around with seasonality and all these other concepts, but at the end of the day, it's supply and demand and price action. And we have this bearish event right now that is allegedly bearish, which this Fed event on Friday, the inflation numbers or the PCE numbers, and I still think we're in a spot here where we have to be careful of that wall of worry. Let me know if you have any other questions. Overall, as I look at this, it has remained the situation of the lack of follow through. The drop that we had last week for various reasons, if you look at the 200-day moving average on the S&P, I mean, this was almost, I don't want to say it was a no-brainer, but it hit this level. This was a painful resistance level from April and March. I remember this. And, this was a level, and I wrote about it in the S&P recap, but we basically had said this level, and then, kind of the, like I said, this level. And so we have this, the failure of the 200-day moving average. The other thing also, and I have this other tool that I've created. Let me see if I can actually bring this up, which is, this is my MA streak. And this is the thing that counts how many days the moving average has been rising. The 10-day moving average, I'll just go back to that. And this exists in TradeStation as well. I've shared this with you guys. I can share it again. Email me if you want. But when the 10-day moving average really rises for this many days, like more than 20 days, you have to simply be like, okay, I'm just not going to chase. And now, if we're broken out to new highs, you can sometimes see it really extend. In certain conditions, it can really extend. But generally, you don't get a streak of rising 10-day moving average usually more than about 20 days before it peters out. But now it has that kind of pause. So this is the sort of thing that, from my perspective, is the sort of pause in the euphoria that can allow the trend to continue. This is an overbought indicator. This is my own creation, but I have found it to be useful. There's simply a point in time when the 10-day moving average cannot continue to climb. This is one of the things I like about this compared to something else like the 8-day exponential or something, is that moves so quickly, and when you're using like the 8-day exponential, it'll start to fall sometimes, and the 10-day is a smoother indicator. So those are the most things I want to talk about. Like for me, I'm just continuing to watch if we hold this level and guarding against the risk of the bears being forced to cover into the close. Hope everyone has a great day. Please email me if you have any other questions. Hope everyone has a great end of summer. Take care.